Well, thank you for staying with us on the AM show. And of course, we get into that all-important issue. We told you to be tabling it. The banks, as of last year, had incurred a lot of losses on the back, directly, if you like to speak, of the domestic debt exchange program. And that's according to the annual financial report. We'll be getting you some details of that, and joining us in the studio to analyze that, among others, we have Sairam Kawa. He's a senior lecturer at the University of Cape Coast School of Business, and we also have Professor Lord Mensah, who is with the University of Ghana Business School. But to situate the conversation, we're talking about those situations that led to the banks suffering the losses we have heard that they suffered. Of course, there's been a lot of talk about that, and now it's come to the fore. So how did this happen? And what exactly is going on? Well, to break down the matters further, we have our editor for Joy Business, Nixon Yabua, joining the conversation. Mr. Yabua, a very good morning to you.
Good morning.
It's good to have you.
It's good to be here too.
It's been a while since we
exactly.
we did this.
Since I made some comment on issues currently happening within our dispensation.
Right. Before we get into those issues, Dr. Michael Ayamga as well has joined the conversation. He's an economist at the University for Development Studies. Doc, a very good morning to you as well. You would have to unmute, Doc, when we come back to you.
Good morning, and nice to join you this morning.
Great. So, Sairam Kawa is in the studio here with us as well. Sairam, good morning.
Good morning.
Good to have you.
Nice meeting.
Today we meet face to face.
Sure.
In living color. Yeah. So I'll come back to you, Mr. Yabua, or Nixon. I know we're too familiar to be doing Mr. Yabua things here.
Nixon Yabua.
What exactly is happening? What has happened to the banking sector, and what does this latest report reveal?
Well, this was expected, because if you look at the bank's exposure to Government of Ghana securities, obviously once we undertake a debt exchange, or I would prefer to call it debt restructuring, it will definitely impact on their business. If you look at the financials that they've released so far, their assets have been impaired largely because of their exposure to GOG securities or bonds. And for me, it's something that is quite problematic, because
it's significant, isn't it?
When it happens like that, you should expect that the banks will slow down lending to the private sector and households,
which has a ripple effect.
Exactly, and that is where the issue is, because if there is low money in circulation, then you should expect that consumer spending will also be a problem. You won't see a lot of financial intermediation within the financial space, and that is where the challenge is. We do not know the number of years that this debt exchange will impact on the banks and consequently the financial sector. But for me, I feel that this has to do with risk issue, because operating as a financial institution, you need to be very careful. You need to monitor the elements of financial risk, i.e. interest rates, i.e. currency. And I feel that some of the banks, I do not know, but maybe failed to prioritize financial risk. They thought that government security was absolutely risk-free. But as we speak today, government securities is not risk-free.
One thing we know in business circles, but which has come to the fore now, nothing is risk-free. But of course, we know that lending to government across the world is seen to be one of the easiest ways. We call it low-hanging fruit, right?
Exactly.
But in this instance, when something like this happens, then it bites hard.
Exactly.
And then you realize that maybe you miscalculated. Exactly. But you see the likes of Standard Bank, PLC, listening to the news yesterday, even they, with their cash flows, have been hit, big as they are, established as they are. And we can also talk about the sums of money. I've forgotten what term you use for it, the 400 million, the capitalization.
The minimum capital requirement.
You get it. Now, all of that comes into play because the banks are wobbling.
I was going to speak on that. For now, even though some of the banks have some level of funds in their income surplus item. Some may be affected and they would have to recapitalize. And if you look at, if you study the monetary policy report by the central bank in March, they have given the banks a minimum of 3 years to improve their capital. So we call it paid up capital. And there's a need for more analysis to be done with respect to the financial statement released by the banks. That will give us an indication whether Bank A or Bank B would have to show up its capital, you know. So then the question of the banking reform in 2018, 2019 comes comes into fruition in the sense that we recapitalize the banks from a certain amount to a certain amount, but now exchange rate fluctuation and inflation has eaten into the capital, and that has become a problem. So someone will say that we did a fine banking sector reforms, but here again, we have come back to cost 90.
It's square one, basically, because what this means is the banks are bleeding. They are not going to be lending as much. We've spoken about agri financing, for example. It means the whatever, less than 4% is going to shrink even further. What does that mean? It has an effect on farmers and what they can produce. So they are also going to, last year we had lots of conversations where people were saying, instead of upscaling, they are now downscaling or downsizing. What would that mean for food security, food sufficiency in the country? Then you talk about lending to businesses, small businesses especially, because the big ones, sometimes they have economies of scale, so they can manage the situation. But the small businesses that are dependent on loans, now those loans are going to be few and far between. And then we can also talk about those who are already on loan, and the monetary policy rate and everything else and how it affects them. If you're on a facility, it means these are heady winds that you're flying into.
So if you are on a fixed rate, then you are at an advantageous position. But you know, most businesses apply for loans on a floating rate. So it matches with economic conditions. And that is where the challenge is. The multinationals,
because they are variable.
Yes, the multinationals or the foreign institutions have an advantage because they can depend on their parent companies. I hope you are getting. For instance, the multinational banks, the Nigerian bank, they were very smart when Fitch started sending signal that we may default on our, loans, or the country's loans or bonds. In the sense that in 2021, before I think 2019, before COVID, the signs were there.
They were there.
At the rate of borrowing was going to send us into a ditch.
Even without COVID and this Russo-Ukrainian war, things would have still happened on the back of our overborrowing.
I will quote the World Bank country director, Pierre Laporte. He was on another station, and he mentioned categorically that if Ghana experienced a shock, we are likely to have issues. And that is what we are seeing today. So COVID, Russia and Ukraine hit the economy, and we are in tatters. If you look at the indicators, in economics, economists work with data. Finance and economic professionals work with data, and data doesn't lie. Once you use the model to compute the data, you would arrive at a particular result.
Conclusion.
And anyone who go by the same method would get the same result.
So moving forward, right before we let go of you, moving forward, what does this mean for our banks? Many of them, after the banking sector cleanup, we had many of them merge. Now, even after merging, some of them are going to have to recapitalize. They are going through severe financial straits. What are the projections when it comes to our banks? I know that for some of the well-established ones, those from outside that have been here for about a century and others which have been in operation across the world for a long time, they may have systems, mop-up systems across the world to be able to deal with the situation. But how about the others? What likely is going to happen? What are we going to see?
Well, let me say that in terms of systems, the central bank had done quite well. to ensure that the banks are sound and stable. We are hoping that the Financial Stability Fund would be established as quickly as possible. We know that the World Bank has made commitment. So banks that are highly impacted would have to depend on the Stability Fund to survive. But if you look at our financial space, largely they are dominated by multinationals. Even the Nigerian banks, I mean, we classify them as multinationals. Many of them would depend on their parent company, like I said earlier, to recapitalize. We all know that Standard Bank, First National Bank, parent company, which is First Rank, have already indicated that they would recapitalize their operations here. What I am worried is the real sector. The banking system, or the banks, are the engine of the economy globally. So therefore, when the banks are impacted by any shock, it comes back to hit the real sector. So if you walk around, people will tell you that they do not have money, or there's no money in their pocket. And that is the reality we are facing now. However, we are hoping that things will not take too long for the banking sector to bounce back.
But is that a realistic projection? Like you said, in financial circles, we prognosticate, but we prognosticate on facts.
Absolutely, absolutely. But we are hoping that we'll get the IMF program. For that one, the survival of this economy hinges on the IMF program. You cannot run away from it. Our reserves...
We've got to such a point of instability that...
It's almost depleted. And for you to have 2 weeks import cover is really a
Recently, we spoke about our reserves and the fact that we're in dire straits.
Another shock.
Right.
You are doomed.
It could be anything.
So we are praying that we will get the IMF program, hopefully latest next month, or at worst by June.
But it's taking pretty long, isn't it? We said, yes, June, but the signs, the writing on the wall, I know this is really not, but the writing on the wall is not looking too good. The last time there was supposed to be some debate on it at the IMF level, they swerved us.
You know, yesterday I was speaking to one of the top economists in this country. He once worked with a fund for 10 years, and I won't mention his name because I will not be fair to him. He was making a point, and I totally agreed with him. The fund appears to be playing diplomacy with us, and they are not comfortable with certain decisions made by our authorities in the past. And because they have interest, they have,
there's a stake. Yeah.
They have exposure in terms of our economic management. They also are mindful not to lose some of their loans to us. You know, it's very critical. So it's quite difficult for now to say categorically that we are going to get the program tomorrow or on Saturday. You know, that's where the danger is. And because he had that experience at the fund, chairing over 300 board meetings, according to him, he do not think that we have gotten to the position where we will secure the fund program as soon as possible. And that is where my worry is. So I feel that if the authorities are listening, perhaps they have to readjust or reposition themselves and have the belief that we should do A, B, C, D in order to secure the program as quickly as possible. Because the danger is that prices of goods and services could escalate. Exchange rate is at risk if we do not get the fund program, because we need the fund to improve our balance of payments. That is very critical.
Charles Nixon Yeboah is head of Joy Business, a Joy Business editor, and he joined us as well on that bit. Chazi, that's how he usually call him. Thanks for joining the conversation. Let's now go on Zoom and have an interaction with Well, we have Professor Lord Mensah of the University of Ghana Business School. We also have Dr. Ayamga connecting with us. I'll start with you, Dr. Ayamga. What do you make of this latest report and what it evinces when it comes to our banks and how healthy they are?
Yeah, good morning, Ben. I think it's worrisome, and it's something that was already hitting us. You have to look at the manner in which we did the domestic debt restructuring, and then you would realize that apart from we knowing that the banking sector was going to be the first to be impacted, the manner in which the restructuring was done exacerbated these things and accelerated the rate at which they are happening. Many of us, yes, expected the banks to take in some losses, but we didn't expect that it will happen so soon. And that is because of the way in which the Minister of Finance handled the debt restructuring program in the domestic arena. It is because he looked more like the banker in the deal or no deal show rather than someone who was leading, providing all the information, and then letting the banks be in a position to analyze their risk, analyze their exposure, adequately prepare their consumer base and their customer base, and then either plan, make mitigations, and then see how they could overcome these things. But they were taken aback. The minister kept information and used the information to get others to come on board and others to not. So that is why we are here. We expected this banking loss, but not so quickly. Of course, why did we expect it? We knew definitely that the banks are somehow exposed. And because they are exposed, they have to write off a significant proportion of their loans as bad debts. That is because, first, we are seeing a dampening business environment characterized by reduced investor confidence. You are looking at a situation where inflation is increasing, the cost of borrowing is going up. And also, more importantly, you are looking at a system where people are jittery, people are not sure of what is going to happen. So when people are uncertain, they tend to keep money longer, what we call a reduced money velocity. And that means that when they get money, they don't spend. All this culminates in a weakening business environment. And that means that if the business environment is weakened, businesses are not able to pay banks what they owe them. And if they don't pay the banks have to write off these loans and then get exposed. That's one of the challenges we face. Secondly, the banks have also been exposed in the equity market, the share market. Their share values are falling and they are no longer attractive. So nobody wants to take his money and go and invest in banks. And because their share prices are falling, their values are falling. And if banks' values are falling, they are not attractive, they don't get the customer base in order to grow. So the banks are not also growing. If you look at all these things, what happens? It is the real sector, businesses not being able to do the real production, produce the goods and services that we need to keep our economy going. And that is also going to translate into government not also meeting its revenue targets. So either way you look at it, either from the banking side or even from the real sector, we are going to experience significant shortfalls. That is why I think that this development has come rather too quickly. Everywhere in the world, when the financial sector starts showing signs of weakness, then it means that you are headed in for disaster. We didn't expect that this would start so quickly, but we knew it was coming. Now everybody is talking about some banks having the ability to absorb these losses because they are multinationals, their parent companies may help them navigate these challenges. But my worry is that if we do not see significant indications that the business environment can reboot and come back into full swing, you may have some of these banks downscaling and eventually folding up. That is the doomsday scenario, and that is what I fear most going forward.
You say we knew it would come, but we didn't think it would come this quickly. Professor Mensah, what do you make, and I'll come into the studio, I'll have ample time here. What do you make of this latest statement in terms of the bank's financial health? And do you also think that we've got to this point a little too soon?
Well, not too soon. It was expected long ago. Let's look at the bank's operations. The bank operates by taking deposits and then giving out loans and then investing. So if you look at a typical balance sheet of a bank, you're going to look at the asset side and you will see cash, you will see treasury bills, you see government bonds, you will see fixed assets. You're going to see all sorts of assets listed at the outside of the balance sheet. Now, clearly, a typical bank, and this is an exercise I've been doing with my students. I teach bank management. Anytime I get new class, I tell my students to pick the last 5 years of, a particular bank, and then we study the balance sheet. And the trend is clear. The trend has always been that most banks have been overly concentrating on government bonds. Banks are not doing the core retailing, which is giving out loans. And I don't blame them on that because of the economic structure.
Yeah.
The company has positioned itself in such a way that you can easily make money without necessarily stressing yourself up. Just accumulate.
Which is what they've been doing. Unfortunately, now the bubble has burst.
Exactly. Just accumulate money and put the money in government instrument, and over time, you'll be fine. Now, if you look at the sequencing of the income statement of the banks from the last 5 years, consistently, banks have been, recording profits over the last 5 years. It's this year that is exceptional. It is exceptional because the only asset that, the asset that they've been concentrating on have been exposed as a result of the debt restructuring. Now, government has slashed down interest rate. So if you look at the various income streams of the banks, you realize that the shortfall is in the interest rate, interest income. And so for me, I'm not surprised because the kind of banking we've been doing in this country has always been that, we overly concentrate on government instrument. And then also the assurance that government gives as a result of satisfying its obligations has always been consistent, with the exception of this year that we had this debt restructuring, that there has been a failure. Apart from that, even the loans that the banks give, they concentrate on contractors who are working with the government. So you could see that the bank's existence thrives on government activities. And over the past years, it's only government that has been in business, because we had an environment where interest rates are high, environment where liquidity has been problematic, and as a result of that, businesses are not able to access funds easily, and so banks tend to lend to government, and then government businesses have been going on. So I'm not surprised at all that the shocks that the economy has received has quickly transcended to the banking sector. It's as a result of the exposures that the way the banks have been operating over the years. But I don't blame them on that anyway. That's how the economy has been structured. The economy has been structured in such a way that only government does business. Ordinary person does not do business much. Access to funds has been a problem. And so that where you can lend to and where you can invest has been in the government, circle. So that is, the problem we're facing now. And I always say that, overly concentration of assets has always been an early warning signal, which, the banks were supposed to pick to indicate that once, something gets hit, as far as economic management is concerned, they're all going to have a problem. And so once you see, when you see banks concentrating their assets in particular areas, especially in the corridors of government instrument, then you should know that, once they get hit, and that's what we call heading in banking. They all head in a particular area. So once there's a hole, they all fall in it. Not surprised, more than 90% of the banks will be recording losses this year. But hey, let's go back in the years. These banks have been building reserves over the years. So the shock that they are receiving this year, and if you extend it backwards, they should have some kind of neutralization. And so for me, it is surprising, but then all is not lost. They should go back in the years and find a way to neutralize some of the reserve they've been building up with the loss that they've made this year.
Right, and that's the interesting part, because it's not always the case that the banks are this prudent when it comes to managing the resources accrued over the years. Of course, dividends will be paid to shareholders and the rest. And like we've seen, even in terms of the banking sector cleanup, sometimes the banks are simply not as prudent as they ought to be. So that could be problematic. So just to clarify this, just give me a yes or no answer, and I will come to Sarah Mkawo in the studio. We're talking about last year and what happened, but did I hear you say that more than 90% of banks will be incurring losses this year? Is that what you said?
Right, that would be surprised because of the overly concentration in government bonds.
All right. So there you have it. That's the verdict. Let me come to Sarah Mkawo on the same beat. Tricky, turbulent waters, very choppy waters for the banking sector right now. What is your reading of this latest statement?
What we are saying, as my colleagues have explained, is not surprising. The writings have been on the wall, but we have not been proactive in looking at the situation.
I'm sorry, I'm going to have to interrupt. Every time we say the writing was on the wall, you heard Charles Nixon Yeboah, my colleagues, say that even around 2019, right before COVID, the writing was... How come the writing is always on the wall, yet we don't see it?
We've seen it. We live in a country when the experts talk, the technocrats talk, the politicians do not listen. These things have been said a long time ago. Professor Lord Mensah have been talking about Ghana going to IMF, making sure that we right the wrong on the things that have been happening in the country. But that has not been listened to. And so we have been talking about over-concentration on some investment. We've been told, and we've learned all our lives reading, that do not put all your eggs in one basket. But what do we see today? We see the banks investing in government bonds. And government is in trouble and is coming to you to tell you that I am in trouble. Help me out. Let us come out of the woods. You said you are not going to negotiate with government. That is not the right way to go. You see, the reason why the banks are suffering today is because initially they have a higher interest earning with a shorter term period on the instruments that they have. But now it has been exchanged for a lower interest earning with a longer term of payment.
Obviously, that will have an impact.
That is going to have an impact on what the banks are going through. And they are going to record losses for some time until they have recapitalized, until they have diversified their lending and the way they do things. Most of the banks will call you and they will ask you to come for loans. They give loans to businesses without checking whether these businesses are using the loans for the purpose for which they came for it. They have no education. They don't check whether the people actually need the money for what they want to use it for. And hence, if we continue doing things that particular way, we're going to have problems. We have gone through the financial sector cleanup, but we are back. The Bank of Ghana changed the minimum capital requirement from 200 million to 400 million. That's the minimum for some banks. There are banks that are not working. They are not doing the right things. And Bank of Ghana has been on these banks, and that led to the merger of some of the banks. Now, what we are saying, if care is not taken, we may have some more measures coming up.
I was just about to ask, do you foresee further measures happening?
If you don't have enough liquidity, and the Bank of Ghana Financial Stabilization Fund, where they have the Financial Stabilization Council, that comprises the Securities and Exchange Commission, Bank of Ghana, National Insurance Commission, we have the National Pensions Authority, and some others who are part of that particular commission that will look at the impact of the debt exchange, and then they come out with measures to control this. With the establishment of the Stabilization Fund, which is telling us that yes, if you are you are facing liquidity challenges, we would be in a position to help you out. But the 15 billion that they are putting there, the question is, would that be enough? What are the modalities? What are we waiting for to make sure that we get this fund running so that banks, insurance companies, pension schemes that might face some amount of liquidity challenge will be able to access some of these funds? Well, the IMF deal is very significant for us. We need it. We need it to ensure that we shore up the entire development. Look at what is happening in the banking sector. They are incurring losses. If the banks are incurring losses, lending is going to be contracted. If lending is contracted, businesses are not going to get funds to produce. Importers are not getting money to import into the country. Government is losing tax revenue from the banks. You are losing tax revenue from the businesses. The ports.
If the banks bleed,
yes,
you bleed.
You will bleed. If the financial sector is in turmoil, you are going to be in turmoil. And so there is the need for us to safeguard the financial sector. The ports, activities at the port have reduced. And once these things are happening, the revenue that we want to generate so that we can shore up development in the country is not going to work. We want to raise revenue, but then the size of government is still high. We are talking about fiscal discipline in terms of government expenditure. All these things have to work hard. Otherwise, you know, when people lose job, you are not going to get a tax.
Yeah.
And prices of items will go up. Workers are going to suffer. And that will have a huge implication for national security. And so the managers of the economy will need to open up. They open up in the sense that they need to tell us what really the situation is. Involve the players in the industry. Bring technocrats on board. Because whoever the consultants that you are bringing from outside the country will rely on the brains that we have in the country.
Right.
To solve the problems for you.
So interesting points you make up to this point. I would like to find out from you, gentlemen, and I'm going to the next round. Maybe this will be addressed to all of you quickly. If you can give me about a minute and a half on it, I'd be grateful. One, so we're looking at these smaller banks, or the banks generally. We've had them have to merge in the past on the back of the banking sector cleanup. Will it necessarily be better if we had fewer banks that, you know, merged and we didn't have, let's say, 20 plus in the system, but we had far less, let's say, a third of that number that are much stronger? Is that the way to go? And again, in terms of government, I don't know what term to use, government-related ones, like the CBG, like the NIB, like the GCB Bank, right? How safe are they in all of these discussions we're having? So I'll start with you, Dr. Ayamga, on this point. I just want brief, succinct, straight to the point reactions. I'll start with you, Dr. Ayamga.
I don't think we have much of a choice here. The market and the economic crisis is going to dictate what we are going to do at the end of the day. It's not a situation of whether we should have some fewer bigger banks or a smaller one. I am one that believes in competition, and I would wish that we had a better financial access, especially given that we are a rural economy largely. It doesn't matter how you want to turn it, and the more accessible banks are to micro businesses and businesses in the rural area, the better. But here is the case that the banks, and just like Professor Mensah rightly put it, the banks have not been taught to behave like banks. They've been overpampered by government, taking the secure option of investing in government bonds, and even where they have to give consumer loans, they give to civil servants, and these loans are largely secured by the earnings and also commitments even to pay people's retirement.
Do you feel that was irresponsible? On hindsight, do you feel that was irresponsible? Before you go on, that action, that decision.
I've always maintained that our banks have not been behaving like how banks in other places behave. They don't actually take risks. And what you do is you take risks, make profit, and learn from it. They have largely taken the secure lines, relying on government, and now that government is sinking, this is also telling on them. And my fear is that the period is too short for them to learn how to behave like banks. So at the end of the day, we have to go through this painful process of merging some of them again, downsizing some. And unfortunately, some may have their licenses withdrawn. Even if that doesn't happen, I expect that some of these foreign banks, if they don't have confidence in our economy, they may gradually wind down, and we may see some withdrawal of some foreign banks, and we're going to have some serious challenges there. I think, and I must say that IMF has not been straightforward with government. I said the last time that the managing director...
Did you just say the IMF had not been straightforward with government?
Yeah, it hasn't.
My colleague was earlier saying that the IMF was being diplomatic. You are thinking the same way.
Behaving like a banker. You go to the bank will tell you your idea is a bad one. They don't speak to the government like an economist. And this is our government, the head is sweet. You tell them something, they don't take just a compliment to make you look happy. They come to the table, they come tell Ghanaians that they are happy with us. Everybody who has been watching what the IMF has been telling this government knows that if you look at the data doesn't tell you the same story. And instead of actually telling government the truth and letting it work on a better program, it has been telling them, oh, you are almost there, you have gone through a lot of pain to achieve the unlocked funds. But it's not pain you go through. It is a consistent program backed by a proof of debt sustainability that gets you an IMF program. It's not the amount of pain you go through. And if you have the IMF providing this kind of feedback to government, then it doesn't allow government to listen to the technocrats, experts, like Sayo rightly said.
All right. Thank you very much. Interesting points you have made there. Let me come to Professor Lord Mensah. Do you concur? Are you in agreement with Dr. Ayamga that some of these banks may have their licenses eventually withdrawn? As for the mergers, it is clear they are going to happen. What is your take on that, even as we look at the other aspect of the conversation, sir? Hello, Prof. Professor Mensah?
Yeah, I'm here.
Did you get the question, please?
I didn't get a question. Can you take me back, please?
So the same one, I posed it to all of you, the local banks, the homegrown ones, CBG, NIB, GCB Bank, among others. What do you foresee happening to them in this picture? And it escapes me the other bit I posed about, generally, yes, it was about whether a smaller group of banks is necessarily healthier, whether that is healthier for us. But a quick point was made by Dr. Ayamga that some banks may have their licenses withdrawn. Do you agree with him on that?
Yeah, I don't.
You don't?
See, we need to appreciate the financial architecture of banking in this country. You see, once the financial system assumes a certain shape, right? difficult to, destroy it. And when you destroy it, it has a serious economic repercussions. That is what we did, for the banking sector cleanup. And I tell you, we're not going to come out of that, together with this debt restructuring and all those. It's going to be difficult. What the bank needs to do in their next level of, intake of liabilities, taking on people's deposit, just to match it up with, government maturities, instrument, and other, assets that they would like to convert them to. I don't believe in, more or less putting up, new mergers and other banks are being acquired and all those. You will distort the financial system. What we need in this country is not about the numbers number of banks. We need to look at what we call client outreach. Where the banks, comes to establishment, and then possibly look at the number of clients they are reaching out there as far as, retailing is concerned. A typical bank must, do what we call financial intermediation. And that is, the bank's main, job. What we have witnessed in the past has been financial disintermediation, where the banks are not retailing, but they are rather investing in government instruments. And sometimes I termed it, lazy banking in a way. But in the end, it is the economy that has put that shape of, financial structure, where banks will take deposit and then invest it in government instrument.
Right.
But I don't in, merging banks that will get weaker. After all, we have the, Financial Stability Fund. Those banks that the Bank of Ghana, and I know Bank of Ghana will not like to do any wave of mergers and acquisitions again, as it happened in the banking sector cleanup. They can't afford the cost.
So what is going to happen then?
Now, if you do that, a lot of people are going to struggle in assessing the financial system. You're going to end up having strong banks, because already there is, a slogan in the financial space that we say, big banks are too big to fail. What is happening in the system now, with the losses that the banks are making, I can tell you the big banks, looking at their, profit over the past 5 years, they should be able to receive some of these shocks. What about the smaller banks? When it comes to tapping into the, what do we call it? The bank, the stability fund, I think, they should prioritize them and get to know the weaker ones that they can support. Because, if you go all out and say all the banks should come and tap into the stability fund, trust me, you may end up, giving monies to banks that could have, received the shocks that they are going through now. So for me, I don't think we need any wave of merger or any wave of acquisitions. What we need is structured bank, well liquefied, for them to change, their, activities, by extending loans to businesses and individuals, rather than investing in government instruments.
Let me come now into the studio so it is clear, but I don't see a lot of you really looking at the GCB banks and the others. What is your take on that?
Yeah, the GCB, NIB, ADB, CBG, these are banks that are very crucial to the sustainability of this economy. They have a chunk of the funds of Ghanaians, and government cannot afford to allow these banks to go down. And that protection has been given to these banks for some time now. You remember the ADB share issue, where there were a group of persons from, is it Unibank, that bought shares in that particular bank, and then the stock exchange will have to come in to cancel the deal. They have to go to court, and the court upheld that particular situation, because these banks play a crucial role. And you look at ADB, they serve a lot of people who are not in the affluent, who are not the affluent in society. The GCB, same way. And they are some of the largest that we can find. Except for the course of the measure, we have the Consolidated Bank of Ghana being the largest that we have in the country. And so the banking sector is very crucial to the existence of every economy around the world.
All right.
If your banking sector is down, your economy is down. It's the life of the country. You cannot just allow it to go down. And government, through the Bank of Ghana, what we have experienced earlier on, I'm sure would not allow this to go down. And hence the establishment of the Financial Sector Stabilization Fund to ensure that banks go into that. We need to assure Ghanaians that, yes, the Professor Lord Mensah made mention of the outreach, the education. People are banking. They are saving money. But banking is not all about saving money and taking loans. There are other things the banks will have to educate people on. If I'm coming for a loan from you, what are the types of interest rate that I have?
I mean, a lot of people don't even know whether their terms, their loan facilities are variable or fixed.
Fixed, yes.
In fact, it is only now that a lot of people go and say, but you used to take this out of my account. Why are you taking so much more? Oh, your terms are actually variable, not fixed.
So people don't know about it. So we need to do that. The banks are supposed to connect people who have surplus amount of money to those who have deficit, those who have investment opportunities, but they don't have the money. Connect all these things so that there will be financial intermediation, breaking the risks, breaking the bulk. But at the end of the day, the banks only concentrate on, let me give you loan because you are on a government payroll and the money will be taken from source. And that is all. And that will not be enough. So going forward for the banks and the other ones that we have, yes, a lot of people are interested in banking now, but they don't understand the banking concepts.
All right.
The products that are available. And there is the need for thorough and better education in the banking sector. Not everybody. Banking should be from senior high, even junior high school.
Even primary, at the primary level, I mean.
That in the system. Once it is in the system, we will have this. National service, what are we using them for? People have done business, accounting. They understand these things. Can't we organize them and send them to the various markets, the various villages, so that they will give a lot of education to the people to know what is happening? So if you are coming to defraud me, I will be able to know that, no, this is not what...
So more education as far as the financial space is concerned. Yes,
that is what is going to keep our system running.
2 quick shots at each one of you, gentlemen. Not bullets, though, but question shots. And I would have you throw back your answers quickly at me. This time, I'll start with you, Seyram, in the studio. 1, has the banking sector cleanup, what we had, has it lived up to expectation? Because we're here, back to square one. And in fact, we're still paying for the last banking sector cleanup. So it creates a very tricky situation. Then 2, how much of a role has the domestic debt exchange program played in what we are seeing now as far as our banks are concerned? Quick thoughts.
1, if not for the banking sector cleanup, we would have had worse situation than what we are experiencing now.
Even barring the cost,
yes,
which we're still paying.
We are still
20+ billion.
If had it not been that, and if you read reports that have been sent out, it is prudent for Bank of Ghana to take some of the decisions that they have taken to safeguard savings, though some people are still struggling to get their monies from the other fund managers and all those things. It is also very important for us to know that, yes, we are still paying though, but hey, it is better. It would have been worse than what we are seeing now. You remember there are people who are at the law court.
Still
for some of these things. If you allow these people to still be in the banking sector, when they don't have capital and the liquidity support that is being given to you, you use the liquidity support to establish another bank. and the people are struggling,
Yeah.
and you use money to divert into other production areas,
Yeah.
those things are very hard. The domestic debt exchange actually affected what we are seeing today. As I've said earlier on, people have...
If you had on a scale of 1 to 10, how much would you attribute in terms of causative factors to what we are seeing now from the banks?
About 80%.
80%.
80%.
All right. Thank you. Let me go to Dr. Ayamga on the same points. Please, gentlemen, try and let's make this quick enough. There are a few other points I want us to address, so let's not dwell too much on these. Be very succinct if you can. Dr. Ayamga.
Yes, I would say the banking sector cleanup was necessary. Was it rightly done? I don't think so. We needed to separate the issues of things that border on criminality, misapplication of banking resources from people that had genuine challenges with managing their liquidity. And I felt that the approach shouldn't have just been to get everyone out of the stream. There are some banks, and I still stand today, and I believe that the Ingram group of banks that was transforming the rural area. I'm from the rural area, and I can attest to the fact that that bank was actually providing the financial intermediation that the big banks in the cities were not doing. And I felt that the approach that we used to lump all these banks that were having problems together and apply almost the same formula to them, but at different periods in time, was not the right decision. So I would say that yes, the banking sector cleanup was necessary, but the approach we used is not the best, and that is why we have not seen the benefits of the banking sector cleanup. And it has fed into this domestic debt exchange program, which I believe has accelerated the rate at which the problems we anticipated with this, our debt crisis, has come. So all I would say is straight to the point that I would give maybe close to 60–70% on domestic debt exchange program. But
more than, did you say more than 70%?
No, I won't say more than 70% because you see.
No, I just want you to re-echo what you said. Did you say that?
I'll allocate about 70% to the domestic debt exchange program.
All right.
Regardless of who have arrived here in
Professor Mensah, on those same points. Hello, Prof. Prof, please unmute.
Right. So can you hear me now, please?
I can. Go ahead.
Right. So the domestic debt exchange has not paid for itself. Let me put it that way. We had this debt exchange somewhere around 20. We're not talking about the banking sector cleanup has not paid for itself because it was an economic exercise, and for economic exercise, we're expecting that at least we'll have some time to get the money that we spent on this cleanup back. If you look at the taxes that has been collected from the banking sector over the past years, has it been able to cover the 21 billion that was spent on this cleanup? I mean, let's ask ourselves a simple question. If you put that together, you realize that the exercise has not paid for itself. It was an exercise that we needed badly as a country. But then the question is, how did we approach it? Now, let's take a particular bank into perspective. When a bank is in existence for more than 5 years, that bank, operates creating economic benefit and at the same time social benefit. If you try to restructure the banking system and as a result of cleanup and people lose their jobs, to some extent, those who lose their jobs, where they were sending their kids to school as a result of, for the fact that they were working in a bank, being able to pay school fees.
Unfortunately, the connection is a bit problematic. Let's just see whether we can get Professor Lord Mensah back to complete the thoughts that he was sharing. Prof? Prof, we're going to try to do this again. It appears the connection is bad. Maybe we'll have you join the conversation via the phone line so we can cap it off in just a bit. But we've addressed quite a number of the issues. I want us now to take a look at the IMF program, or even before that, there is this little bit I want us to take a look at when it comes to the Bank of Ghana. In fact, when we look at our debt to GDP ratio, we see that the impact, according to Fitch Ratings, Ghana's debt to GDP has fallen by only 1% despite debt restructuring. And again, the likes of Professor Bokpin have stated that data on the economy does not add up, and that the Bank of Ghana should come again. Before we get into that, Prof, you were making a quick point.
You know, if you look at the social and economic aspect of the banking sector cleanup, I will say that we've not paid for the 21 billion that we spent on this, cleanup.
Right.
So from where I sit, it has not paid for itself.
So will another such program be an even heftier burden for us? Is that a burden we can carry? Is it a burden we can realistically carry?
We can't. That is why I indicated earlier that, the country cannot go through those kind of, restructuring again. Right. Changing the financial architecture will be a huge cost to the country.
Right. Right. So let's get into that next bit of the questioning. Again, I'll start with you. I believe I've given everyone a bite on the last one. Your data on the economy does not add up. Professor Bokpin has been addressed at the Bank of Ghana. We know the story there. But even more importantly, Ghana's debt to GDP has fallen by only 1% despite the domestic debt exchange, or the debt restructuring program we've embarked on. That's according to Fitch Ratings. What do you make of these? Are you in agreement? And though it may be 1%, what does that 1% mean?
It's worrying. It's worrying because the entire debt exchange, and for us to get a relief or a reduction in the debt to GDP ratio by 20-something, by 55%. And that is why we are doing this, to ensure that our debt levels are sustainable. If all what we have done is just resulting into 1%, it's a worrying signal for us. That might be one of the reasons why IMF is trying to be diplomatic with us in the way they handle the entire debt situation.
Because if after everything we've done, all the pain we felt, it's just 1% shaved off.
It means that, we've been saying that government has not been forthcoming with information on the debt exchange and what the real purpose of the exchange is supposed to achieve. So if all that we've gone through, the struggling, the strike that people have gone through is resulting into 1%, then it's a clear signal. And the External Creditors Committee has not been formed yet to get an assurance from these people. And we are not living in an island. All these people are watching, they are listening, they are reading what is happening in the country. And once they are doing this, they also want you to play a role. You've gone to them for 17th, this is the 17th time you are going to them for the same issues. Haven't you learned anything from it?
Maybe this time even worse.
Worse than what you have done. Why do we always go back? Why can't we do our own things? We mismanage the resources of the country. We are destroying our water bodies, and it is all over the place. It is cost. It is money. We're saying that we are building hospitals. We borrow money to build hospital, and then we pollute the water bodies for the people to go to the hospital, and we use our money in taking care of these people. No, we cannot continue in this cycle. And so the IMF deal, we need it all right. But if all what we have done is just 1%, which means that the data that is being used is not clear per Prof. which tells us that government needs to come clear on this whole issue. You see, government should know that they are not alone. The citizens are in this together. If the sector goes down, we are all down. We are all players in the industry. You are not the only one who have knowledge in the management of the economy. Please bring everybody along. Open up the space. There are ideas that will come. The person who is on the street that you think does not have any idea about the management of the economy, you will be shocked, will be the one that will give a little new idea, and that will be the one that will work for us. So government should come down so that we all come on board, and then we push this country forward. The over-politicization of the issues of the economy, especially when it comes to the banking, the financial sector, and all those things, is destroying our country. And we all need to come on board. Lack of clarity is the one that is pushing parliamentarians to do what they are doing in terms of we are passing the bill, we are not passing the bill. Because of lack of clarity, parliamentarians must come on board. Everybody who is a citizen of this country should come on board. But who would make it possible? It is government that can make it possible.
Same for you, Dr. Ayamga and Prof. Doc, briefly on the same point.
As I said, I'm not surprised by the lack of movement in our debt to GDP ratio.
1%, is that not incredibly small? 1%?
We don't have a program. We have what I told my friends, it's the IMF program. We want to ride on the tailwinds of speculation that we have a program, signing a program that responds to our economic challenges. That is
right.
what we have been doing. And it doesn't matter how you look at it. We did not design a program that, first of all, led to some fiscal discipline.
Right.
That we cut government expenditure, which is the cause of the ballooning debt anyway. And remember the last time I told you, if you look at the numbers, this is a government that has been borrowing at about 8 billion a year for the last 5 years or so. So you can't just get up and then write a program seeking 3 billion to solve a 50 billion issue.
Right.
That is not going to wash, and that has been one of them. We have misdiagnosed the problem. We have designed a program in such a way that we want to get people in the economy to believe that we have a program and then change speculation and other things, not actually addressing economic issues here.
Right.
And the diplomacy of the IMF, as they say, is contributing to this. People don't want Ghana to fail because of our strategic importance. But that does not mean that if we are not designing an IMF program, we shouldn't be told in the face.
All right.
And because we have told in the face, the numbers don't lie and the numbers don't do diplomacy. That is why we have only achieved just 1%. And I'm even surprised we got that 1% because I wrote off this program right from the beginning because it doesn't respond to anything. First, nobody knows what it is. And it is strange that you are at the IMF negotiating, and many of the stakeholders in the country don't actually know the content of the IMF program. And
right.
That is the problem.
Right. That is the problem. Professor Mensah, the very final round, even as you address that, so I want to start with you. The very final round, I just want a very incredibly brief take. IMF program, what are your expectations? When are we getting it? But you can address the other aspect as well. Professor Mensah, very briefly on this.
With a debt to GDP ratio increasing, reducing by 1% margin, there are two indicators that goes into debt to GDP ratio. It's your
right.
debt levels and at the same time, your GDP. So, we recorded marginal growth when it comes to our GDP in 2022. And so if you are to compute the debt to GDP and you use the lag GDP, then obviously you should expect that there will be, a marginal, reduction as far as our, debt to GDP is concerned. I can tell you that, the chunk of our debt is sitting out there. Even though if you look at, in terms of cities, it's 50-50. If you convert and relate, the exchange rate and the rate at which our, CD has been depreciated over the past month, clearly it tells you that before we can reduce, our debt, we may have to restructure, the external debt very well. And hey, look, you see, we compute the debt to GDP looking at your debt in accumulation. The fact that you have done, debt restructuring does not mean that those debts are wiped off. They have been spread over the years. So a longer period, the only difference is that burden upon burden on yearly basis will be reduced. So what we have done in our domestic debt restructuring, which we seek to do externally as well, is that government want to ease burden of interest payment and some principal payments, year on year, so that we prolong our debt. But the debt still remains the same. But then
we're losing Prof again. Unfortunately, we would have to move the conversation forward. And actually, we're capping off. IMF program or no IMF program? Very briefly, IMF program?
We need the IMF program. For me, at least by the end of the quarter.
By the end of the quarter?
Yeah.
Can we make it?
We can if we engage more with our external creditors.
Do we need more honesty?
Prof, please we need more than honesty, transparency, accountability.
We need honesty, transparency, accountability before we can get the IMF.
We can get the IMF deal. If we don't get it, we will not.
Thank you, Sairam. Dr. Ayamga, you didn't speak on the IMF bid. Very briefly, what do we need to cross that hurdle?
Yes, I think I'll agree with my colleague.
All right.
There's need for us to be more transparent, but we need it. It's like a cancerous leg. We need to cut it off before we treat. So the IMF is the amputation we need to stabilize our bleeding. So yes, we need the IMF. As to whether we'll get it this quarter, I doubt. I think I'm more optimistic that going into the next quarter. But this quarter, the way it is, unless someone the other way, we are not getting a program.
All right, you're doubtful we can get it in this quarter. You think we'll get it in the next quarter. Prof, you're finally back. You have the final word and we cap it off.
So I was saying that the marginal reduction in our debt to GDP has to do with the marginal increase in the GDP that we witnessed in 2022. But then as to whether we'll get the IMF within this quarter, for me, I would even prefer we get the IMF in the last quarter. Government must position itself, you're
afraid of you're afraid of the spending in an electoral year, right?
Exactly. Government must position itself. And the budget that we're going to have, the budget review and the main budget for 2024 must reflect, the economy we have, not necessarily throwing out numbers which will call for, serious unnecessary financing.
All right. Thank you very much, gentlemen. You just heard Professor Lord Mensah, lecturer at the University of Ghana Business School. We also had joining the conversation Sairam Kawa, senior lecturer, University of Cape Coast School of Business. Sairam, it's really good. Today you joined us in the studio.
Yes.
We also had Dr. Michael Ayamga, I beg your pardon, Dr. Michael Ayamga, economist at the University for Development Studies. Gentlemen, thank you so much for your time. Before we get into that next conversation, crucial conversation as well, we're talking money matters and food in our schools. Water is life. Awake, of course, is purified water, premium purified water treated through a strict purification process to ensure that every bottle on the market refreshes you better. And in terms of sizes, it's everyone is in there. If it's your children, 330, 500 ml bottles, you can just fit it into their backpacks or bags and they can take it to school. If you're a heavy drinker, 750 milliliters. If you drink even more, 1.5 liters, just like I would do in a given day. If you're thinking of offices and homes, you can get the 19-liter jar bottles for your office or home. That is ideal. So all you need to do now is stay awake with Awake Purified Drinking Water. It's another quality product by Casapreco Company Limited. And here's the heartwarming part. If you actually make a purchase An amount is donated to the National Cardiothoracic Center for every bottle you purchase. And of course, that is indeed heartwarming. This advert is approved by the FDA. When we return, it's about our caterers, the school feeding program. They are saying you can't intimidate us, you can't rough us up and get us back, though some of them are beginning to go back. And they are also petitioning that while their backlog of arrears ought to be paid, they also want the grant to be increased from 97 pesos to 3 cedis. What should we know on that? Well, that conversation right after the break.